Hi, Karen Bangs here with Cal Poly's Industrial and Manufacturing Engineering Department to go through our third example involving MACRS, Modified Accelerated Cost Recovery System, depreciation. In this example, we're going to add an additional complexity of what do we do when we dispose of an asset, when we stop using it. How do we handle the remaining book value, our accumulated depreciation, etc. So let's read the problem statement. Excuse me. O'Leary Engineering Corporation has been depreciating a $50,000 machine for the last 3 years. The asset was just sold for 60% of its first cost, so 60% of the $50,000. The machine is classified as a 7-year property for MACRS GDS. What is the size of the recaptured depreciation, I also call that a gain, or loss at the disposal using MACRS? So let's just review a couple of points to begin with, and let me scroll down here a bit in order to do that. I just want to remind us all that the cost basis is what we paid for it in any trade-in value. So it's telling us, I believe in this problem, we'll re-verify that it's $50,000, and we didn't trade anything in like we did on the bus example. The general depreciation system, any MACRS actually, whether it's ADS or GDS, ignores salvage value when calculating depreciation. Remember, depreciation is based on the total market value. Our total cost basis is really what that should say, is based on our total cost basis. The book value at the end of the depreciable life, no matter what the life is, 3, 5, 7, 15, 20, is 0 at the end of the depreciable life. Those are all old, so those will review for us. The new concept here is the gain or loss that we incur at the disposal of an asset is calculated by taking the market value at the time we dispose of the asset minus the book value at the time we dispose of the asset, and then that is our gain or loss. If market value is higher than book value, then that's a gain, that's positive, that's going to be a add to our net income, and we'll have to pay taxes on that. If market value is less than book value, then that's going to create a loss, and that means that will reduce our taxable income and we would pay less in taxes. Okay? So let's scroll back up to the top here. In this case, it's telling us that this machine is a 7-year property. So we don't have a description of what the machine is, we just have that it's a 7-year property. So we can go over to our table and we see that unlike the 5-year properties we used in the past, we're not going to use that column. We're going to use the column of 7-year properties. So instead of 20% depreciation in the first year, we're going to have 14.29% depreciation in the first year, then 24.49. As always, even though it's a 7-year property class for MACRS, it depreciates over 8 years, a half a year in the first year, a half a year in the second year, and then 6 full years in the middle. You can see here too where it converts over to from double declining balance to straight line here. And we know that that conversion happens when the straight line depreciation for the year would be higher than the double declining balance for the year. It converts to straight line. And then we can take it all the way to 0 so that we are sure that we have depreciated the full 100% of our asset. So those are the rates that we're going to use. So here we have the infamous table by now that I highly recommend that you use. We have what we paid for it was $50,000. It doesn't give us anything about installation, transportation, any other trade-in, so just $50,000 is our total cost basis, really, our market value or cost basis at the time of purchase. Then the salvage value at the end of its life when we first put it into production was expected to be $2,000. We expected to use it for 8 years, so the salvage value was $2,000 at the end of 8 years when we first put it into production. And we have a recovery period based on the type of equipment this machine is of 7 years. So as I mentioned, we use the rates that are from the table, so they're shown here. And we know that those all add up to 100%, so we're going to be fully depreciated by the end of 8 years. And as we noted in the other videos, our depreciation for the year is the recovery rate times the total cost to put the machine in service, which in this case is $50,000. So 50,000 times 14.29% is 7,145. Then we have an ending book value of 50,000 minus the depreciation of 7,145 is 42,875. And we go down here, just as another example, we see again the recovery rate of 12.49% in year 4 times the cost basis of $50,000 gives us depreciation of $6,245. Our remaining book value is the prior period's ending book value minus depreciation. That gives us the ending book value. So we have our depreciation schedule here. But that isn't, and we see that we have a book value of 0 at the end of year 8, which is what would be expected given the 7-year life. But we don't keep it for that whole time. We actually sell the asset at the end of 3 years. And we sell it for 60% of $50,000. We sell it for $30,000. So how do we handle that as far as our books go? Because we're not going to be able to take the rest of this depreciation because the asset is no longer with us. We're no longer using it. And we still have $21,865 of book value left that we haven't taken the value of the equipment to the income statement via depreciation expense yet. So what do we do with that? Because we've got to get the book value to zero if we're not going to be using this asset. If we're getting rid of it, we have to get it off of our books. So what would we do? So what we would do is we would have the same information here, but we see now we're stopping at the end of 3 years. So we have a book value of $21,865 and we have accumulated depreciation of $28,135. Again, if we add up the accumulated depreciation plus the remaining book value, that's going to be our $50,000. So we see that we're still good here, but now we have $21,865 that we have to somehow get off of our books. So how do we do that? So first, the first scenario, as the problem states, we are selling the machine at the end of year 3 for 60% of its original cost. 60% of $50,000 is $30,000. So that's our market value minus our remaining book value that we have from right up here. Our remaining book value of $21,865 says that we have a gain of $8,135. So we can take all of the expense of the book value, all the remaining book value as an expense for this period, and it will be offset by the $30,000 that we sold, plus we'll have an additional $8,000 of profit, $8,000 of gain that we'll have to pay taxes on. Okay? Market value minus book value equals gain or loss, which is what we showed over here. Yes, market value minus book value is the gain or loss on asset disposal. And then let's have a second scenario here. So we have the first scenario where we had a gain. Now let's say scenario 2 is we still are selling it at the end of year 3, but instead of selling it for 60% of original cost, we're selling it for 10% of original cost. So in that case, we're only going to get 10% times $50,000. We're only going to get $5,000 is what the market value is at the end of year 3. It's only $5,000 minus the book value, because we still have to write that down. We have to take that as an expense to get the book value to 0. That says we have a loss on asset disposal. This should say gain or loss, gain or loss. We have a loss, which is demonstrated by having brackets around it as well, a loss of $16,865. So that's going to reduce our profit and therefore reduce the amount of taxes that we pay as well. All right, so that was how we handle asset disposal. Is we take the market value, what we're going to get for the asset at the time that we're taking it out of service, minus the book value, and that gives us a gain or loss on the asset disposal. So we write the book value down to 0 and either have a gain if the market value is higher than the book value, or a loss if the market value is lower than the book value. And that concludes our examples for MACRS depreciation. Thank you.